me get across to Vivek Rajpal, who is India Fixed Income Strategist at Nomura, joins us on the phone from Singapore. Good morning, Vivek. Thanks so much for taking our call. Did the pace of increase in the FPI limits, keep pace with what you had expected?
Well, expectations were, there was a wide range of expectations. I think the increase is probably on the lower side of expectation. 0.5% per year is, having said that, 0.5% per year increase, if you really look into the numbers and assume current utilization stays, then it still brings approximately INR 500 billion for the full fiscal year, which is 10 to 12% of 12% of total net supply. So it should be treated neutral by the markets.
There is also a corporate limit hike, though, Vivek, and I think there was an expectation or a hope that they would increase it, but nobody was entirely sure. So if you take that together with the government bond hike, there is a substantial amount of room now, right, for foreign money?
Yes, absolutely. So if you look historically, if you look from a total perspective, GSEC plus corporate bonds, etc., the total increase in limit is decent enough, and even in good years, we have got this kind of a money for full year. So overall, it's positive. I'm just saying that if somebody has had elevated expectations of 1% per increase per annum, that it is less than that. But overall, I think it's neutral to a medium-term positive for the market.
On the government bond side, Vivek, I would assume that interest would have been back. There was a short period of time where FPIs were selling, but I think with the factors which have changed, lower borrowing, etc., it looks like FPI interest would be back. So you would expect that limit to more or less get used up as it gets opened up?
Absolutely. I think FPI as an investor class will continue to increase its exposure in Indian bonds, and it will become increasingly important investor class for Indian bond markets. Yes, I expect utilization to increase as we go ahead in the year. I think the kind of selling that we observed for a brief period of time was temporary, but with supply-demand issues getting resolved and authorities becoming proactive, along with the fact that inflation trajectory seems to be panning out favorably. Global markets are more or less conducive for the rates environment, suggests that FPIs will continue to buy.
Vivek, could we move closer to 7%, back to 7% on the 10-year?
So near term, my range expectation is 705, 725. But based on the inflation trajectory, yes, if inflation continues to remain benign, I'll not be surprised to see 10-year bond yield closer to 7% in a month or so.
Vivek, last word, slightly, sort of pointless question, but I'm going to ask it in any case. No interest from the FPI community on state development loans at all? I mean, I continue to argue that none of these states have actually defaulted. So while I know that there's problem of data visibility, etc., on state finances, it could make for an interesting investment for FPIs.
Well, yes, but as you said, first of all, I think there is no differential pricing between various states at the moment. And in terms of liquidity as well, G6 or central government securities are much more liquid than SDLs, which is why I believe G6 will still be a preferred source of investment for FPIs. As market develops, as market pricing mechanism gets mature, and as liquidity in the market improves, SDL may become a choice of instruments, but probably not in the near term. That's more of a medium term.
Sure, Vivek, just a last question. I think between the government's decision to cut first half borrowings, the RBI or the MPC's decision to bring down the inflation forecast for the year, spreading of MTM, and now FPI limits being increased, looks like the bond markets have pretty much gotten what they wanted. Do you see generally, the first half borrowing program go through smoothly unless something untoward comes about? I think Friday's auction went off pretty smoothly.
Yes, actually, I'm pretty constructive on bond markets, and I'm not constructive just after this news. I was hopeful that supply-demand issues, which were really the technical issues, will get resolved. I think fundamentally as well, the way things are panning out, I am pretty constructive on the bond markets. I mean, historically, if you see, Indian bond markets haven't commanded as much term premium as they are commanding now. So relative to repo rate, we are still like 115 basis points above the repo rate. My sense is, given that authorities have become proactive and valuations are still attractive and fundamentals like inflation are panning out in the right direction, H1 borrowing program or H1 borrowing bond supply absorption shouldn't be a problem at all.
Got that, Vivek. Thank you so much for taking time to speak to us, Vivek Rajpal of Nomura there.